Usually, debt is treated like this looming shadow, right?
Mm.
Like something you're just supposed to avoid at absolutely all costs.
Oh, yeah, completely. It's got a terrible reputation.
Right. But when you actually look under the hood of the financial system, that shadow starts to look a lot more like, well, like a highly predictable machine.
A very predictable machine.
Exactly. So today, we are tearing apart the mechanics of personal loans to show you exactly how to pull the levers. And we're not just going to read you like a boring checklist of how to fill out an application.
No, definitely not.
The mission for this deep dive is to decode the system from the inside out. We really want to equip you with the why and the how so you can navigate borrowing money intelligently without, stepping on any of those hidden landmines that are just built into the process.
And I mean, in a world of absolute information overload, understanding those underlying mechanics is essentially your ultimate financial safety net.
Oh, 100%.
Because personal loans are incredibly common, yet the actual mechanisms of how they are priced and underwritten remain completely shrouded in confusion for most borrowers. I mean, they just don't know.
Yeah, it's like a black box.
It really is. So what we are doing today is synthesizing a comprehensive guide to connect the micro level of your daily household cash flow all the way up to the macro level of Federal Reserve policies.
Right.
Because understanding how those two extremes interact is what actually keeps your head above water.
Exactly. So whether you are listening to this right now because you are, I don't know, trying to fund a massive home improvement project, or you're desperately trying to figure out how to restructure mounting credit card debt, we're going to completely reframe how you approach your liabilities.
It's a total mindset shift.
It is. Let's get right into the anatomy of a smart borrowing scenario.
Yeah.
Because before we even touch the mechanics of execution, we really have to look at the strategic intent. Like, why take on an unsecured loan in the first place?
Well, intent dictates the entire outcome, right? The source material we have outlined several key scenarios where a personal loan actually makes mathematical sense, rather than just being like a panic response to needing cash.
Right.
It is not just about acquiring capital. It's about what specific type of capital you are acquiring and what existing liabilities you are replacing with it.
Okay, so the biggest use case that jumps out from our research is debt consolidation. And the mathematical spread here is what really, it really caught my eye.
It's wild.
It's insane. The text points out that average rates on personal loans are nearly 8 percentage points lower than average credit card rates.
Yeah, 8%
8 full percent.
Yeah.
If you are carrying a revolving balance,
Yeah.
that is a massive amount of your income just evaporating into compound interest charges every single month.
Just gone.
Exactly. So refinancing that over to a personal loan fundamentally stops the bleeding.
And what's fascinating here is the secondary, almost hidden benefit of doing exactly that.
Oh, right. This part was crazy.
Yeah, because it's not just the immediate capital saved on the interest rate spread. Our sources highlight that consolidating high-interest credit card debt into a personal loan can actually result in a significant sudden improvement to your credit score.
Okay, stop right there.
Yep.
Because logically, that sounds completely backward to me.
I know it does.
Like, I am taking out a massive new loan, taking on thousands of dollars of new debt, and the credit algorithms somehow look at me and decide I am less risky. How does that mechanism actually work?
So it comes down to how the credit bureaus strictly divide and weigh different types of debt. They are specifically focusing on your credit utilization ratio.
Okay.
That ratio is a measure of how much credit you are currently using compared to your total available limits. But here's the kicker. It primarily weighs revolving accounts, like credit cards.
I see.
So when you max out a credit card, your revolving utilization spikes toward 100%. And the algorithm penalizes you heavily because it assumes you are in a liquidity crisis.
But a personal loan is categorized differently.
Exactly. A personal loan is an installment loan. It had a fixed balance and a fixed payoff date.
Right.
When you use an installment loan to zero out your credit cards, your revolving credit utilization suddenly drops to zero.
Wow.
You haven't magically erased the debt from your life, obviously, but you have moved it out of the highly penalized revolving category and into the much safer installment category.
That is wild.
Yeah, the credit scoring models love this because it shows structured, predictable repayment rather than, open-ended compounding risk.
That is such a brilliant way to legally manipulate the algorithm in your favor. I look at an unsecured personal loan more like a financial Swiss Army knife or a bridge.
Oh, I like that analogy.
Yeah, because on one hand, it gets you away from that compounding credit card trap. On the other hand, the source points out you can use it to build a bridge to a specific asset, like buying a used boat, without having to actually put the boat up as collateral.
Right, because it's an unsecured loan, the bank doesn't put a lien on your property.
Exactly. Or, it acts as a bridge during a crisis, functioning as a rapid emergency fund.
Two, the text notes that with some lenders, you literally just need a qualifying credit profile to get same-day funding. But this does raise an important question about behavioral finance and how we react in a crisis.
Which actually brings me to my primary pushback on this whole concept.
Let's hear it.
If I have a genuine emergency, let's say a pipe bursts in my house or my car transmission just drops out on the highway, I am pulling out the plastic in my wallet.
Oh, for sure.
I am not going to sit down, compare lenders, wait for underwriting, and sign loan documents. In a panic, frictionlessness wins. Why wouldn't I just swipe my credit card?
Honestly, you are exactly right.
Okay, so I'm not crazy.
No. In hour one of a crisis, liquidity wins. You swipe the card to get the plumber out to your house immediately.
Right.
But what our sources are arguing is that in week two, you should be looking at a personal loan.
So you use the loan to permanently refinance the panic swipe.
Precisely. Swiping the credit card is frictionless, but the cost of that frictionlessness is aggressive compounding interest.
Yeah, it adds up so fast.
It does. If you know you cannot pay off that $5,000 transmission repair by the end of the month, that balance is going to snowball. Personal loans provide unsecured cash extremely fast to pay off that specific swipe, but they do it with a fixed interest rate and a fixed amortization schedule.
So it's locked in.
Yes. You trade a tiny bit of deferred paperwork for a massive amount of long-term structural stability. You aren't leaving the debt exposed to compounding interest.
So what does this all mean? It means a personal loan isn't just an injection of cash. It's a deliberate structural upgrade to how you manage your liabilities.
Exactly.
But here's where we hit a massive logical contradiction. If debt consolidation is this popular and people are constantly using these loans, shouldn't the cost of borrowing universally shift when the broader economy shifts?
You would think so.
Right. But our source material reveals an absolutely massive disconnect between what the Federal Reserve does and what the consumer actually experiences.
Yes, this is what I call the macroeconomic illusion. Consumers inherently assume a direct one-to-one relationship.
Right, like if the Fed does something, my bank does the same thing.
Exactly. They think that if the Federal Reserve announces a rate cut in Washington, money is instantly and universally cheaper at their local bank.
But the data tells a deeply contrasting story when you isolate the personal loan market.
The statistic in the text is actually staggering. Listen to the spread on this. Since September 2024, the Federal Reserve cut rates by more than a full percentage point.
Which is huge.
That is a massive injection of liquidity into the financial system. Yet, the average personal loan rate only slipped 15 basis points. That is 0.15%.
Which is practically a rounding error.
It is. It's like the wholesale price of global coffee beans dropping massively, but your local cafe only discounts your morning latte by a single penny.
That's a perfect way to put it. Where is that margin going? Why aren't the lenders passing those newly lowered borrowing costs down to the consumer?
Well, if we connect this to the bigger picture, it comes down to a fundamental economic mechanism called inelastic demand. And it perfectly explains why lenders hoard that margin.
Okay, let's unpack this. How does inelastic demand actually function in the loan market?
Inelastic demand simply means that the consumer's need for a product does not drop just because the price remains high.
Okay.
Think about the exact scenarios we just discussed. Desperate debt consolidation, sudden medical emergencies, emergency home repairs.
Yeah.
People need this money regardless of what the Federal Reserve Chair is doing.
Right, because my roof doesn't care about the Fed rate.
Exactly. If your roof is actively leaking, you are not waiting around to see if the Fed cuts rates by another 0.25% next quarter. Because of that consistent, highly motivated demand, lenders know they have a captive audience walking through their digital doors every single day.
So they have absolutely no incentive to drop their rates just because their own underlying costs went down. Yeah. They just widen their profit margin.
Exactly. They keep the spread. But there is a secondary, much more severe economic warning we need to extract from the text here.
What's that?
While the price of the loan, the interest rate might remain rigidly high when the economy shifts, the availability of the loan is incredibly elastic. The text explicitly notes that lenders constantly adjust their underwriting standards based on their fear of macroeconomic conditions.
Meaning, if there are whispers of a recession or widespread job losses in the news, lenders get spooked.
Highly spooked.
Yeah.
During those periods, they quickly pull back. They tighten their lending algorithms, lower their approval rates, and demand higher credit scores.
Wow.
Yeah, making it significantly harder to qualify for an unsecured loan, even if your specific personal financial situation hasn't changed one bit.
So the crucial takeaway for you, the listener, is that trying to time the market by waiting around for the Fed to save you is a losing strategy. The macroeconomy might dictate whether the bank leaves its doors open during a recession, but it doesn't really dictate the price tag on the money inside.
Precisely.
You have to base your borrowing decisions on your own personal cash flow needs and your own timeline.
Which naturally brings us back to the micro level, because if the Federal Reserve doesn't control your final interest rate, you have to look at the mechanisms that actually do.
Right. The locus of control shifts entirely to the borrower. This is the prep work, the self-assessment phase. Before you even open a new tab to look at a bank's website, the source provides a rigid framework for interrogating your own financial reality.
It's so important.
It is. You have to ask yourself, how fast do you actually need these funds? Because if you need it tomorrow, you are automatically filtering out slower traditional banks. But the biggest tension the text highlights is how quickly you want to pay the loan off.
The term length. This is where borrowers face a fundamental mathematical conflict.
Exactly. There is a war between two different repayment philosophies, and you have to know which camp you are in before you apply.
Right.
On one side, you have the short-term strategy, say, a highly aggressive 2- or 3-year repayment term. Mechanically, your required monthly payments are going to be painfully high, eating up a lot of your current liquidity.
Yep.
But because you are amortizing the debt so quickly, you save an absolute fortune in total interest over the life of the loan.
And on the other side?
On the other side, you have the long-term defensive strategy.
Yeah.
You stretch that exact same loan amount out for 5 or 7 years to secure the absolute lowest possible monthly payment.
Which feels safer.
It does. This gives your daily household budget maximum breathing room and reduces your risk of missing a payment. But the math dictates you will pay significantly more in total interest by the time it is over.
It is the classic trade-off between monthly cash flow and total cost. And the text makes it emphatically clear. Using a personal loan calculator to map out those different terms against your real-world income is non-negotiable.
You have to run the numbers.
You cannot guess what a 7-year term feels like versus a 3-year term.
But even with a perfectly stress-tested budget, the interest rate you actually plug into that calculator is dictated by one algorithm.
The credit score algorithm.
Yeah.
As we established, improving your credit score does infinitely more to secure a favorable rate than waiting on macroeconomic shifts. The text emphasizes that your credit profile is the single heaviest weight in a lender's pricing model. Borrowers in the top tier get deals that radically undercut the national average.
The text gives us the actual mechanisms to optimize that score, too. The first is obvious, paying bills on time, because payment history makes up the largest chunk of the algorithm.
Right.
The second is mastering that utilization ratio we discussed earlier. The rule of thumb the source gives is keeping revolving utilization strictly below 30%.
Crucial.
But the third point is the one that frustrates me the most, honestly. Checking your credit report for errors.
Oh, it is a systemic flaw.
It is crazy to think about. A simple clerical error by a third-party data broker, someone mistyping an address or confusing you with someone with a similar name, can technically lock you out of a decent APR.
It happens all the time.
Disputing those errors isn't just annoying admin work. It is literally the mechanism by which you reclaim your financial leverage from a broken data system.
It is entirely within your control to police those data brokers. But we have to acknowledge the reality of timing.
What do you mean?
Well, what if a borrower does everything right, checks their score, and they find out it is simply mediocre? If they are facing an immediate financial bottleneck, they do not have 6 months to slowly rehabilitate their credit profile.
Oh, right. But the source material actually offers a highly effective structural workaround for exactly that scenario.
Oh, the co-applicant strategy.
Yeah. If your credit isn't in tip-top shape, you should consider a joint personal loan with a co-applicant. By attaching someone else's excellent credit score to your application, the lender essentially uses manual underwriting to blend your risk profiles.
Right.
You get to borrow their financial reputation to unlock the lower rates you couldn't access independently.
It is a powerful mechanism, though obviously it carries severe interpersonal risks.
Oh, absolutely.
Both applicants are legally, jointly, and severally liable for the debt, meaning if one defaults, the other's pristine credit score is immediately destroyed.
It's a high-stakes trust exercise, for sure. So let's say you have navigated the prep. You have interrogated your budget, optimize your credit profile, or secured a co-applicant. You know your ideal term length. Now you are stepping onto the battlefield.
The fun part.
Right. This is the execution phase. Shopping lenders and avoiding the traps.
And this is precisely where consumers leave thousands of dollars on the table. The behavioral default is to simply log into your primary checking account, click the loan offer button, accept whatever rate your current bank gives you, and assume you received a fair market deal.
Which is the worst thing you can do.
The absolute worst.
The source explicitly instructs us to compare the requirements, APRs, and fees of at least 3 different lenders. 3 is the absolute baseline.
Right.
You need to look at your traditional bank, sure, but you must cross-reference that against online-only lenders and credit unions. And the mechanism you use to do this safely is called pre-qualification.
Pre-qualification is your armor during this reconnaissance phase.
And I think a lot of people are terrified of this step. I know I used to assume that any time a bank even glanced at my credit profile, my score would drop. How does pre-qualification bypass that penalty?
It is all about the difference between a hard inquiry and a soft inquiry within the Bureau's algorithm.
Okay.
When you formally apply for a line of credit, the lender requests your complete file. This registers as a hard inquiry. Statistically, someone seeking multiple new lines of credit rapidly is an elevated default risk.
Because it looks like they're desperate for cash.
Exactly. So the algorithm automatically tunes your score to reflect that risk.
But a soft inquiry operates differently.
Yes. A soft inquiry, which is what pre-qualification uses, is categorized merely as an account review or a background check. You submit basic income data on a lender site, and they run a soft pull to give you a highly accurate estimate of the rate they will offer.
Wow.
Because it isn't a formal demand for credit, it completely bypasses the Bureau's penalty system. You can pre-qualify with 10 different lenders in a single afternoon, compare all their internal rates side by side, and your official credit score remains entirely untouched.
That is massive. You can essentially map out the entire battlefield without taking any fire.
Exactly.
But here's where it gets really interesting and, frankly, incredibly deceptive. The text issues a major warning about the fine print on these pre-qualification offers.
Oh, the fees.
Yeah, the fees. When you are looking at those 3 lenders, you cannot just look at the advertised interest rate. You have to look for structural traps. Specifically, the source points out that some lenders charge origination fees of more than 10% of the total amount you borrow.
A 10% fee just to originate the loan? Think about the physical math on that for a second.
Exactly. If you were taking out a $20,000 personal loan to completely wipe out your credit cards, a 10% origination fee means the lender is slicing $2,000 right off the top before the money even moves.
Ouch.
You only get $18,000 deposited into your checking account, but you are legally obligated to pay back and pay interest on the full $20,000.
It is an astronomical penalty. Why would a lender do this? Why not just charge a higher interest rate instead of hiding a 10% fee?
Because they are gaming the comparison aggregator algorithms. If we connect this to the bigger picture, it is a brilliant, albeit deceptive, marketing tactic.
How so?
Borrowers naturally sort loan offers by the lowest advertised interest rate.
Obviously.
Right. So by shifting their profit margin out of the interest rate and into a massive upfront origination fee, a lender can artificially suppress their advertised interest rate.
Oh, wow.
They shoot to the top of the search results, looking like the cheapest option, while burying their actual profit in the fine print. This is why financial literacy regarding the APR is so vital. Right, the APR, or annual percentage rate.
Yes. The interest rate is strictly the annualized cost of borrowing the principal, but the APR is the true total cost of the loan calculated mathematically to include the interest rate plus all those hidden structural costs, like that 10% origination fee.
That makes total sense.
A lender might lure you in with a dazzlingly low interest rate, but when you look at the APR, you realize the true cost of their capital is actually terrible.
It is the ultimate bait and switch.
Yeah.
So the ironclad rule from the source is that you must compare the APR across your 3 lenders, never just the interest rate.
Never.
Once you have navigated that specific minefield, avoided the exorbitant origination fees, and locked in the genuinely lowest APR, you move into the final administrative stretch.
Which is largely just verification.
Right.
The lender is going to want concrete proof of everything you claim during pre-qualification. You will likely need to upload recent pay stubs to prove a predictable cash flow, W-2s, and tax documents so they can formalize the underwriting.
And once you digitally sign that final agreement, the sheer velocity of modern finance takes over. The text notes that some online lenders can physically fund your loan within one single business day.
It's incredibly fast.
The capital just appears in your account, ready to be immediately deployed to execute that debt consolidation strategy or cover that emergency.
And as a final, highly actionable mechanism for the repayment phase itself, the source stresses one last detail. Always enroll in automatic payments.
Beyond just the obvious benefit of ensuring you don't accidentally miss a payment and destroy the credit score you just worked so hard to protect, is there a financial incentive?
Yes, a literal mathematical discount. Many lenders offer an APR reduction, sometimes a quarter of a percentage point, or more simply for setting up autopay.
Wait, really?
Yeah. From their perspective, it drastically lowers the statistical risk of you defaulting or requiring costly collections outreach, so they pass a fraction of that saved risk premium back to you. It makes the physical act of repayment effortless, and it inherently lowers the total interest you pay from day one.
So to pull all of these moving parts together, we have journeyed from understanding the algorithmic benefits of shifting from revolving to installment debt, navigated the illusion of macroeconomic rate cuts, and finally broke down the deceptive marketing of origination fees.
It's a lot to process, but it's crucial.
It is. The overarching theme from our source material is undeniable. Personal loans are a profoundly powerful financial safety net. They sit perfectly positioned between the chaos of unexpected life expenses and the wealth-destroying reality of compound credit card interest.
Absolutely.
But they are only effective if you approach them as a calculated structural upgrade, armed with a rigorously tested budget and a highly watchful eye on the APR.
And through it all, remember that your personal credit profile is your true armor. The Federal Reserve is not coming to artificially suppress your interest rate. Actively managing your credit utilization and aggressively policing data broker errors is the ultimate way to insulate yourself from unpredictable economic weather.
You are your own central bank. Your preparation dictates your pricing.
You know, there is a fascinating psychological question embedded deep in this source material that I think is worth dwelling on as we wrap up.
Oh, what's that?
The text explicitly states that the optimal time to utilize a personal loan is when you want a, quote, definite payoff date for your liabilities.
Right, the strict amortization schedule, the
It's-
ticking clock.
Exactly. And it makes you wonder about the underlying behavioral psychology of how we interact with our debt. Does the structure of the financial product fundamentally alter our discipline?
That's a great question.
Think about the endless, revolving nature of credit cards. You can just pay the minimum balance forever and the card remains active. Does that lack of friction trick our brains into feeling less urgency?
Probably, yeah.
Does it normalize the debt? Whereas the rigid, unyielding structure of a personal loan, that definitive, non-negotiable endpoint on the calendar, forces a level of financial discipline that we otherwise wouldn't adopt.
It is the difference between learning to live with a chronic ache versus putting a cast on a broken bone and aggressively managing the healing process until a specific date. It's a structural enforcement of discipline, something for you to ponder the next time you reach for your wallet. Are you using a tool that actually forces a resolution or just one that comfortably extends the problem? Thanks for joining us in this deep dive. We will see you next time.